Let's talk about the MACD indicator. Hey, welcome back YouTube. My name is Mike Swartz. Today, I'm going to share with you guys a MACD trading strategy. So MACD is a very popular and free indicator across multiple platforms. So let's go ahead and jump into the charts and I'm going to show you how I use the MACD indicator. All right, so here we are in the TradingView charting platform. Now, in my own personal trading, I use NinjaTrader, but TradingView is a free platform. So if you want to follow along in this video, you guys can just go to tradingview.com and get started today. Zero money, it costs you nothing. This is the free version that I'm actually using to record this video. All right, so what we want to do is we want to come over here to where it says indicators, and we can just type in MACD and click on the very top one. Now it's going to add the MACD indicator down here to our charts. A couple things I'm going to do real quick is I'm going to leave these settings the way they are, but under style, what I want to do is I want to thicken up the lines just a bit, just to make it easier for us to see for this video. So I'm going to thicken all the lines to a number 3. And oops, click here, go to number 3. And the signal line, make it number 3 as well. All right, so here's a MACD indicator down in the lower portion of the screen. Now, the most common use for it is when we see the two lines cross. That could be like the blue line crossing the red line. That could be a sign that the market is bullish. When the blue line crosses below the red line, that could be bearish. But what do these lines actually mean? Well, if we come over here to Investopedia.com, essentially the moving average convergence divergence, that's what MACD stands for, is the 26 period EMA, subtract that from the 12 period EMA. That's what gives us this blue MACD line. So the blue line right here is the 26 period moving average EMA minus the 12 period EMA moving average. And that's how we get the blue line. The signal line, which is the 9, it's a 9 EMA of the MACD actual line. So very, very simple. It's a momentum based strategy. Now, so let's talk about it. What is one of the most effective ways to use a MACD indicator within any trading strategy? Now, what I found the most useful over the course of time wasn't necessarily the crossing of the lines, because sometimes we'll get a cross here, dip back up, cross down, dip back up, cross down, so on and so forth. But one of the things that we can use the MACD indicator for is divergence. It's very good for picking up divergence. And here's what divergence is. We can see the market ran up here, made a high. The MACD indicator was at its peak point right here. Then the market dips down. We come right back. We test this high once again. But now look, the MACD indicator is now slightly lower. All right, so if we look right here, we can see the MACD indicator is sloping downward. All right, if we look at the peaks from here to here, clearly on a downswing. So, that to me is a sign of potential bearish. And then we come up and we actually do a triple top third test. And what is the MACD indicator telling us? It's telling us, hey, not so quick. The momentum to the upside is not there right now. Doesn't mean it can't come back. But as of right now, it's not down. And when I start to see the MACD divergence, what I want to look for is potential bearish price action. All right, so I want to use multiple analysis techniques. The first being the MACD indicator saying, hey, dummy, look at the chart. You might want to do something here. And then the second is, okay, do we have any bearish price action candles? And right here, we have what's called an inverted hammer. And we could basically put a sell stop right below here, look and take a little bit of money off the table. Now, depending on what your risk parameters are in your trade, we can set up a trade. And let me see if I can come over here real quick. Now, we're going to see if we can set up a positive reward to risk ratio. So let's see if we can set it there. Okay, so right here is a 1-to-1. If we drag, we drag this target down, all right, right about here will be a 1.5 to 1. But again, I wouldn't want to have my stop loss that far up. I want it a little bit above the highest peak. So let's see where 1.5, actually we'll go to 2-to-1, right? 2-to-1 reward to risk ratio would be right down here. If you want a 1.5, you could adjust that and your target would be right around this area right here on the price chart. And again, this becomes a very highly effective trading strategy. One of the things that you want to keep in mind, however, is, how much risk are you willing to take on the trade? And then 2, what type of bearish price action candles are you looking for? In this example right here, I was looking at the inverted hammer. But if you focus on just two primary, price action candles, one being an inverted hammer and the other being an engulfing type of candle, you'll see that that drastically improves your trading. And then we also had the benefit of the MACD lines crossing right after our trade, which really helps it out. Even as we came back up for the third test, you can see not only did we have the divergence sloping downward, but the MACD lines they still maintained a bearish cross the entire time. Now, the first example is on the Eurodollar. Now, on this example, I'm using the SPY ETF, which it tracks the S&P 500. And I want to show you this strategy works across multiple assets. Now, this low right here wasn't quite as low down here, but we can still use a similar technique, meaning that if we look at the lows in the MACD, we can see that it is actually sloping upward. I can draw that for you real quick. We'll take the arrow. Oops. Let's see. Take the arrow, and you can see that the arrow is actually sloping upward as we come down. And then what do we have right here? We have our potential bullish price candle. Now, one of the things that I like to do is wait for price to break the top of that candle. And we can essentially set that order as a buy stop order. And if the market makes it up to that price point, we'll get filled and the market will continue upward. Now, if we come over here and we measure, all right, we want to measure and say, okay, if I was to take the trade here, put your stop loss a few points or so below this low of this candle and try to set up a positive reward to risk ratio, ideally 1.5 or higher. 1.5 would take us to about right here. And in this example, it went as high as a 4-to-1 reward to risk ratio. Now, most people aren't going to target quite that, but generally people try to find somewhere between a 1.5 and 3-to-1 reward to risk ratio. And if we keep the reward to risk ratio intact, that also is going to increase the odds that our strategy will continue to perform well over the course of time, because with a 2-to-1 reward to risk ratio, if you're right 34% of the time minus commissions, then you're essentially break even. And I think most traders out there can find a trading strategy in which they can be right more than 34% of the time. And last but not least, I'm going to show you that this technique will work on Bitcoin. Yes, it works on cryptocurrency. I'm not a crypto trader, but I do want to show you that this technique works across all assets. So here you can see, actually, if we look back over here, you can see we have a low here. The market rallies up, or the market pops up, comes back down. The MACD indicator is going up. The market comes back down again. MACD indicator is still sloping upward. Now, let's assume that maybe you got excited and you said, ooh, we have a double bottom. We're coming down here. We have the MACD divergence. I'm going to get long right here. Well, let's use that example real quick. And if we were to go long there, we'd have our stop loss just below that wick right there. We'd move this up until we have at least a 1.5 reward to risk ratio. And that would have been a very fantastic trade. However, that's not the example I was going to show you. I was going to show you that even as we came over to this area right down here, the market rallied up. It didn't get much of a rally. The market comes back down towards this low. The MACD indicator is still sloping upward. All right, we still have an upward slope in the MACD. This is set up a divergence. We have our bullish engulfing type of candle right here. Ideally, I would not like to see this much of a wick on top. But, everything isn't always as we wish, right? Again, we would enter the break of that candle, placing our stop or buy stop order just above the top of this candle, maybe, 1 or 2 ticks above it. And then we could set our stop loss just below this low over here. And again, we want to adjust this to at least a 1.5 to 1 reward to risk ratio, which would have us targeted right over here. If you're shooting for a, And if you're shooting for a 2-to-1 reward to risk ratio, that would come right up here, which Bitcoin more than exceeded a 2-to-1 reward to risk ratio. All right, so now you guys got a chance to see that this MACD strategy works on, tracking the S&P 500. It works on the Forex market as well as Bitcoin. Now, the goal for you is to be able to spot the divergence, and then you also have to train your eye to look for the bullish price action that will come at that point. If there's no bullish price action, there's no need to take a trade. And one of the things that I found that helps this strategy perform better is waiting for a break of that bullish price action candle. So if it's a bearish price action candle, we put a sell stop right below it. If it's a bullish price action candle, we put a buy stop right above it, making the market prove to us that indeed it does want to go in our direction. Like always, hope you guys found today's video informative. If you did, please give it a big thumbs up. I appreciate it. Till next time, good luck and good trading.